What is a HELOC versus a cash out refinance versus a standalone second? Okay. A home equity line of credit is a way to access your equity, but to continue to be able to draw from it like a line of credit. So that is a credit card. You even get pretty much a credit card when you do it. So when you access a line of credit, it's going to come just like a credit card. It's going to come with an adjustable rate mortgage. But the exception is it's nothing like, sorry, adjustable rate, but it's nothing like a credit card charging you 38%. So there are good reasons to do it. A lot of my business owner clients tend to really like the home equity line of credit because they can access a large portion of their equity for whatever they need. Then when money starts coming back in, they can pay it off, but they can do it again and again and again. So it's always available, almost like that emergency fund. Whereas a cash out refinance and a standalone second is a one-time lump sum payment to you. So a cash out refinance would be refinancing your entire mortgage. Some people don't like to do that because they already have a lower rate. What I like to tell people is I'm not here to help. Like, you have three options, which is really nice. But sometimes some people's rates are not that low, and their credit card balances and other loans that they need to pay off are so much higher that it's better to do the cash out refinance. Now, we have a cash out 90, which means that because a cash out refinance tends to come with a higher interest rate, but you can refinance within 180 days. Within 90 days. So really, you're going to have 3 to 4 months worth of payments. Why 3 to 4 months? Set up a time and talk with me, but 3 to 4 months of that higher interest rate, and then you can refinance and not have the next payment. So why would this be important? I've had people that they wanted to do a cash out refinance because something happened to their roof, and then they also wanted to make some huge upgrades, but they didn't want to come out of pocket for it. That higher interest rate, because they already have a slightly higher interest rate, it only increased their payment like $200 a month, or sorry, $100 a month. So that's $100 a month more in their payment for the next 4 months, let's say. So $400. And then they're able to refinance into a much lower rate, hoping that rates go down. So that's a cash out refinance. Now, a standalone second is I just want a second loan. I leave my rate at 2.875, 3%, whatever it might be. I leave that rate alone, and I have a second loan with a regular, just normal interest rate. It doesn't fluctuate, and it's a one-time lump sum payment. This is great for people who do have a really low interest rate. And to me, they want to make some improvements on their house. They've got medical bills, they've got weddings, they have major repairs on their house that for some reason their homeowner's insurance can't cover, or they don't want to use their homeowner's insurance because they don't want their homeowner's insurance to drop them. That's where a standalone second is huge. Now, remember, a home equity line of credit is nice if you're going to continue to need that money and want to access it multiple times without having to continue to do another loan. The set of closing costs are pretty insignificant for all three compared to when you buy a house. But that's the one benefit of the home equity line of credit. On top of that, I have one that is locked in. Sorry, it's 10 years with an interest-only payment. This is why a lot of my business owner clients like to do it. But I do have a lot of homeowners that are making several repairs. So let's say they've got a kitchen that's going to be, X amount, but then they know that they want to do a pool later. And then they know that they want to do all their bathrooms after, later. So what they do is they access the line of credit, they upgrade their kitchen. Next year or so, they pay it off. Then, or let's say 2 years or whatever it might be, because there's a draw period. So let's say they do a 5-year draw period. 2 years, they pay it off. Then they access the money for the pool. Another 2 years go by, they pay it off, and they do their last draw. They renovate the bathrooms, and it's interest-only payments, so they can make larger payments when they need, keeping more capital in their pocket. That's why it tends to be really nice for business owners, because you never know. Like, I could be making principal and interest payments, but then all of a sudden I need more cash, so I'm just going to make my interest-only payment. Now, where the standalone second is a little different, it's a fixed rate. However, it's one-time draw, and you have to continue to make the payments just like a regular mortgage, but you leave your regular mortgage alone. What I tell people is it's so easy for me to show you 3 different options, show you why you may want one over the other, but to talk about the benefits of both based on your current situation and let you make the decision of which one you want. So if you want to set up a time to talk, I'm licensed in California, Colorado, Texas, Florida, and Michigan. So happy to set up a time to talk. All 3 of those loans, with the exception of Texas. Texas, we have a little bit different loan options because Texas doesn't like us to access people's equity because they think we're cheating you, but it's your equity. And so they're starting to go back on that. And then Michigan can be a little bit different as well. But I'd love to set up a time to talk about those options with you. So thank you.